We know there are many choices in internet radio, and the staff and host of LA Talk Live would like to thank you for choosing the internet's hottest destination for the most eclectic sound and invigorating talk. This is LA Talk Live. We are more than just talk.
Good morning, good morning, good morning, good morning, and welcome to Kick Your Assets into Shape on LA Talk Live. I am your host, Kimberly Kelly-Rolfe, and unfortunately, I am not joined by my other amazing host, James Rolfe. He's out today, sorry, but we certainly miss him. But you know what? We have an awesome show planned for you as usual. So thank you all for tuning in on this wonderful Friday morning. Wow, let's see. Thank God it's Friday, right? Well, for those of you who are just tuning in, maybe for the first time, hopefully not, but potentially for the first time, I'd like to tell you just a little bit about the show. You know, on here on Kick Your Assets into Shape, we get your money straight and your business growing. So, for those of you who are out there knowing you need some help with your finances and knowing you need some help with your business, this is definitely the show that you want to tune into because we have a couple of segments that we go over here. We talk about money talk. On our money talk segment, we're going to help you out with your finances. We talk about things like credit and debt and taxes and just different ways that you can really get a handle on your finances. And then on our Buzz on Business, or I like to say Buzz on Small Business section, we talk about how we can help you to get your business growing. So make sure you tune in every week, 10 a.m. on latalklive.com. Kick your assets into shape. Why? Because we are kicking assets into shape. We're helping you get your money right. We're helping you get your business growing. And you know, some of y'all just need a swift kick. So for those of you out there that just know you need to have your assets kicked into shape, we're going to kick those into shape as well. So thank you again for tuning in. Wow, let's see. I'm trying to think, what do I have going on? Let's see. Oh, got a wonderful event coming up on March 14th at Long Beach City College. For those of you who, you've been tuning in and you've enjoyed the let's see, the shows that we've had. We've been talking about money, but you need just a little bit more help. Well, we're going to be doing an event at Long Beach City College. And at this event, it's going to be a financial empowerment event. So you can come out for 2 hours to get yourself empowered in finances. We're going to help you with that money, y'all, because I know so many of you out there have made these New Year's resolutions saying, for the first time, I'm going to save my money. For the first time, I'm going to get out of debt. For the first time, I'm going to stop using, all this credit when you didn't charge up all your credit cards during the holidays anyway. So come on out to Long Beach City College on March 14th at 6 o'clock because we're going to be doing a wonderful event to empower you in your finances. And those of you who may have been listening at the beginning of the year, we had another event that was scheduled for, I think, next week, Saturday, and we had to cancel that event. So I apologize for those of you who were eagerly anticipating the Woman Take Action event because we had to just change our date. So we'll be announcing that probably a little later in the year. We had a lot of things to come up and it just wasn't a good time. So I apologize to all of you who were, definitely looking forward to that. Okay, so what's coming up? Let's see what else. Oh, tax season. Oh, how could I forget? In case you guys didn't know, in addition to the wonderful workshops and seminars I have the pleasure of doing and being on this amazing show, I also do taxes. Yay! I know you guys probably aren't thinking yay, right? Because most people, it's like they're like, oh, it's tax season. I can't wait to get away. And then there's other people who are saying, yay, it's tax season. I'm going to get a refund. Well, we're going to be talking to you today about taxes. Actually, I'm going to be talking to you because it's just going to be me. I forgot. Whoops. I'll be talking to you today about taxes. We actually started touching a little bit on this topic last week, and my wonderful friend Chamberlain joined us in the studio, and we had some Really good discussion about taxes. And I made a promise to you guys that I was going to go over your 1040 because in fact I told you to run and get your 1040s and we're going to go over the 1040 tax form so that you can kind of understand some of those topics. Well, we didn't quite get to all of it last week because of the wonderful conversation that we were having. So this week I'm going to start working with you on those 1040s. And I'm going to tell you, it's too much information to cover in our little time together. So what I'm going to do is I'm going to try and point out some key things that I really think that many of you probably have an interest in, or and also some things that are based on the questions that I get on a regular basis. So I'm going to try and answer some of those questions for you as well. So go back, get your 1040 forms, but I'm going to tell you, you probably will be holding your last 1040, which will be from 2011. Well, I'm going to be looking at the one for 2012. And I just want to clarify that a little bit because you know that when you file your tax return this year in 2013, you're actually filing it for 2012's income and expenses and tax responsibilities and so forth. So just keep that in mind. But I'm going to be going off of the new 1040 form for 2012 because I want to make sure that I don't miss anything that's coming for this new tax season. And as usual, if you want to communicate with us, you can always give us a call. Let's see, you can call us at the station at actually 323-247-7443. Now, I don't know if we're going to have a lot of time to get the calls today because I want to make sure that I get this important tax information to you today because tax season starts next week on January 30th. That is, I believe, Wednesday. January, is it Wednesday? It might be Tuesday. When is January 30th? Okay, I'm a little confused. But either way, tax season starts next week on the 30th, okay? So whatever day the 30th falls on, just know. And you guys know that's extremely late because typically tax season starts on right around January 15th or 16th, somewhere in there. But this year, IRS pulled a doozy on us. First, they told us they were going to delay it a week, so it was supposed to start on January 23rd. Then they make this big announcement way before January 23rd, of course, to say, oh, we're going to extend tax season this year. And no, I'm sorry, we're going to defer the start of tax season to the 30th. So tax season is actually starting about 2 weeks late this year. So I'm sorry for those of you who are out there eagerly anticipating that tax return. You got to wait a little bit longer to do it. So, for those of you out there who are hearing all these marketing campaigns saying, "Oh, we're doing taxes now," they might be preparing the tax returns right now, but just know that IRS will not accept them by e-file or by mail before the 30th. They have made that quite clear. They said don't even mail them in because even if you mail them in, they're not going to do anything with them until the 30th. So don't waste your time. Or if you want to come in early and just have your tax preparer to prepare them, that's okay too. But just know it won't go off before the 30th. So you got to wait just a little bit longer for that tax refund if you were waiting for that. So we're going to get started in just a few moments. As usual, you guys don't tune in on Facebook as well. Like us at Kick Your Assets Into Shape at Facebook. You can post your questions there. I'm always on Facebook, you guys. They say that the biggest users of social media is women over 40. Now I ain't saying I'm over 40. All I'm saying is us more mature women like social media. So I'm always on social media. So you can always send us a message there if you have a tax question that you want to have answered, or if you want to come in and you want to come in and see us, give us a call at 888-828-3332. Again, that number is 888-828-3332. And you can direct any questions that you might have for us, whether it's about the show or it's about taxes or an upcoming seminar or an event that we have going on. We always have some type of event going on. That's because that's what we do. So always give us a call if you have any questions about that, or again, you can go on Facebook. A lot of times I will post events on Facebook, but I'm going to tell you guys, I've been a little bit behind lately. But the good news is we just got a social media guy who's going to be helping us out with that. So you guys don't have to worry about waiting on me. Because oftentimes I'm so busy that I may not always have time to post the events, even though I'm on Facebook checking things out. I might even be on Twitter sending a little tweet out, but I may not have enough time to post an event. So we will be having our social media guy who's going to handle all of that wonderful social media. Oh, and we got some social media folks here in the studio too at LA Talk Live helping us out. So I want to send out a shout out to our wonderful interns who come to the studio to learn and also to help us out. So thank you, interns. And I think I think that's all that I have for you. No, I'm just kidding. We will get into taxes in just a few minutes, but we're going to go ahead and take just a little bit of break, and I will see you shortly. Tune in just a moment to kick your assets into shape on LA Talk Live. I'm your host, Kimberly Kelly-Rolfe, and I will be back in a moment.
Are you ready to enjoy the Maui lifestyle? You can have it all by owning real estate on the paradise island of Maui. Dennis Rush, a 22-year Maui resident and real estate broker, brings his wealth of experience and market knowledge to add value to your Maui real estate understanding, providing a level of service as unique and exceptional as the island of Maui itself. The magical island of Maui was voted the most exclusive resort island in the world by Condé Nast Traveler, and keep in mind, Maui is only a simple, nonstop flight away. Hawaii Business Magazine Top 100 Realtors awarded Dennis Rush the 2011 fourth top realtor on the island of Maui. Go to www.dennisrush.com to view all of the amazing properties currently available in the Maui MLS system. Whatever your needs or desires, Dennis Rush will provide a private consultation for any Maui properties your heart desires. You will be in good hands. Once again, go to www.dennisrush.com. That's www.dennisrush.com. Contact Dennis today to start your Maui lifestyle now. Dennis Rush, proud sponsors of the Dawn Christie Show and LA Talk Live. Walk, run, climb, play. Solgar number 7 can help. Feel the difference for yourself. Solgar number 7 actually shows improvement in joint comfort within 7 days. Now you can start to get back on track fast and pursue the activities you love. Solgar number 7 is a breakthrough in joint care with no glucosamine and no chondroitin. The advanced bioactives in Solgar number 7 help to increase flexibility, mobility, range of motion, and actually shows improvement within just 7 days. One capsule, once a day, is all you need. When stiff joints occasionally say no, Solgar number 7 says yes. Visit Solgar.com and learn more about Solgar number 7 today. That's www.solgar.com, www.solgar.com. Solgar number 7, official sponsors of Here's to Your Help with Josh Lane and LA Talk Live.
Oh, your skin looks great.
Thank you.
What's your secret?
Frankincense and myrrh oil by Ancient Essence.
Frankincense and myrrh oil by Ancient Essence?
Yes, it's a beauty secret used since the time of the Greeks and Romans. The spa in Malibu told me about frankincense and myrrh by Ancient Essence, and now my skin is lovely.
Well, your skin looks great.
Call Ancient Essence at 1-800-627-9813. Discover the secret of beautiful skin. Call 1-800-627-9813. Discover the secret. Frankincense and myrrh oil by Ancient Essence. Discover the secret of beautiful skin. Available at fine spas and beauty centers.
And welcome back to Kick Your Assets into Shape on latalklive.com. I'm your host, Kimberly Kelly-Rolfe. Okay, y'all. Y'all ready to get into this tough subject of taxes? I know some of you are like, no, no, no. But yeah, we're going to go ahead and dive into taxes. Because I promised you last week that we were going to have a good conversation about taxes, just so that, there's just some key areas that you guys really need to know, and it'll probably help out your tax preparer too. And I want to put a little, toot out there. If you don't have a tax preparer, you can always come by and see me during tax season. Give us a call if you'd like to book an appointment at 888-828-3332. Again, that number is 888-828-3332. Okay, so go ahead. I told you before the break that you need to go ahead and pull out your 1040 form. So I'm going to be looking at the new 1040 for 2012, and you guys will probably be looking at your 1040 for 2011. So let's go ahead and dive right in. I'm going to go into teaching mode here, y'all. I'm coming out of speaker mode for a moment, and I'm going into, or I should say host mode. Coming out of radio show host mode for a minute, and I'm going to a teacher mode. Okay, so when you look at your 1040 form, there's a few things that you're looking at. When you get beyond the personal information, and then you get beyond your filing status and your exemptions, you come down to what's called the income. And I hate doing just such a big jump like that, so I'm going to back up for just a minute. First, I want to talk just briefly, quickly about filing statuses. The average person is going to be either single, married, filing jointly, or head of household. Now, I'm going to touch for just a second about married filing married filing jointly, and head of household. Because some of y'all out there, y'all do some unusual stuff that I really just don't get. Like there'll be two of you in a household married, and you won't file a tax return together because somebody told you that it would be better for you to each file head of household because you can get more money back. Well, you know what? That might be true, but that's illegal. And, I tell people all the time, I'm not one who plays with the law in the first place, but I really don't play with the IRS because they will take you to jail. And if they don't take you to jail, they will take your money. They'll take your whole paycheck. You guys, I am so serious. I've had people in my office sitting there crying because the IRS took their whole paycheck. Okay. And especially when you're expecting a paycheck that day, maybe to pay your rent, to pay whatever it is you have to pay, but the IRS went ahead and went in your account and pulled out your money. You're not happy. So I don't play with people like that. When whatever they ask for, I give them, and I give it to them in all truth and honesty because I don't want them coming back later. Because I mentioned this to you guys on the last show, but the IRS is always about 2 years behind, which means what? It means that if you file a tax return this year in 2013 for your 2012 taxes, do you know whatever you put on that return, they're not going to figure out if there's something wrong or if there's something questionable on there until somewhere around 2015. And can I tell you that by 2015, whatever you put on your tax return for 2012 and 2013, you will have forgotten. So I really encourage you to do the right thing so that when they ask you, you can give honest answers. So let's go back to those filing statuses. So if you are married, and you live together, you're not separated, you should be filing married, filing jointly. Now, there are situations when married people do file head of household, and that's typically because you are legally separated, which means that at the end of 2012, if you are married and you're filing for head of household, it was because you were legally separated by the end of 2012, or at least before 2012 ended, and you have a dependent. Okay, so that's really the main reason why anybody married should be filing for head of household. If you don't follow within in that those guidelines, you should not be filing head of household. Now, anything else y'all get yourself into, you on your own. But I'm just telling you the way you should be doing it. And then in terms of head of household, that status is actually reserved for um, single people who are taking care of a dependent. So you have some type of qualifying person. Maybe you have a disabled um, niece or nephew or brother or sister that you are responsible for, or a child. Maybe you have, or you just have a child that you take care of. You one of your own children. Maybe you have a couple of children. But that tax status is actually reserved for people who are not married typically and have a dependent. Okay, so I'm going to move on from there because that's the only thing I wanted to point out in that section. Let's talk about your exemptions for just a minute. The exemptions are the next section, and what you typically do here is you take an exemption for yourself and maybe your spouse if you're filing married, filing jointly, and any dependents that you have. And each of your exemptions is equal to $3,800 each. So if there are four of you in your household, you would take $3,800 times four, and that's the exemption that you're allowed to take on your tax return. So that helps you to, save a little bit of money on those taxes. Okay, so and that's enough on the on that section, because the rest of what I see there, we may cover just a little bit of it in another section. Okay, so let's talk about income. Okay. Oh no, I'm sorry. Before we move on, let me stay in those exemptions for a little while, because for just a minute. Now, if you notice under exemptions, you can claim yourself, you can claim your spouse, and y'all, okay, let me tell you something else. You cannot claim your spouse as a dependent, okay? It's either married filing joint or married filing separate. You get one or the other. Your spouse is not your dependent, period. I don't care if you work and they don't. It's married filing joint or married filing separate, one or the other, but they are not your dependent, okay? The other thing is, under the dependents department, you should be using your children or children that you are responsible for. So maybe you adopted a child. You can claim that child. You can have a child that was born December 31st at 11:59 p.m. and the good old IRS gives you the right to claim that child for the year. Isn't that wonderful? Yay, we like that. And I like to point that out because there has been clients who came into my office who told me they went to a certain tax institution that I won't mention, and they told them because their child was born so late in the year they couldn't claim them. That's not true. It doesn't matter. The IRS does allow you to claim that dependent. Now, the other thing is, maybe you have situations where there are children that you take care of, or whether they're foster kids, or maybe sometimes you take care of relative kids. You can list those as well. I remember for a couple of years, my husband and I, we took care of my younger brothers and sisters who were much younger than us, but we were raising them all like they were our own children. So they lived in our household the entire year. We were responsible for all of everything that they had: their clothes, their food, their shelter. We were responsible for taking them back and forth to school. So those children we could legally on our taxes provide for. Now, there was one time when my sister didn't live with us the whole year. She had lived with us most of the year, and right around the end of the year, she went to go live back with her mom. So she lived with us through, let's say, I think early December, and the rest of the year, which wasn't very much left, she went to go live with her mom. Now, sometimes situations like that happen, and you can still claim the child. Would her mom have had the right to claim her, or us? We would have had the right to claim her over her mom. And I know that sounds weird, you guys, but what happens is, let's just say that her mom would have decided, you know what, well, this is my child. She's back in my household, even though it's only for the last month of the year. I'm going to go ahead and claim her. So let's say she sent in a tax return and we sent in a tax return. What the IRS will do is they're not going to determine for you who has the right to claim that child. First, they're going to try and get you guys to figure it out. Okay. And then what they'll do is they'll make you prove who was responsible for that child. So they'll start doing things like telling you to go get school records, telling you to go get some type of documentation that proves that you were the caretaker for that child. And at that point, because our names were on all of the school records, our names were on all the medical insurances, our name was on all the different programs and services that we were providing for her, her mom would not have been able to prove that her child and actually lived in our household. And in fact, at the time, I think we were leasing our place and her name was actually on the lease. So, and I'm saying all of this for a reason. Those of you who are out there claiming your sister, uncle, cousin, friend, NIM kids, you know what? It might sound like a good idea at the moment because you're thinking, oh, well, if I claim their kids, I'll get more money back. Yeah, y'all, it's not a good idea at the end of the day. And let me tell you why. Because as I stated, one, you're not supposed to do it. But two, the IRS is usually a couple of years behind. And in 2 years, you might not even remember who those kids that you claim, uh, you may not remember things like what their date of birth was or just some basic stuff that the IRS may ask you, and then when they ask you to prove it and you can't prove that you're not on any of their records, chances are you're going to have to pay that money back. Or let's just say you were claiming a friend's kids and y'all not friends no more. How do you think you're going to go back and prove that you took care of those kids? So I tell all of my clients that if you are taking care of a child, because sometimes there are situations where maybe a parent is having a hard time and that child comes to live with you and you take them to school, you do everything that you're supposed to do, but maybe your name isn't on the school records because the parent never changed the child's school or anything, or you never changed the child's school, so you left everything as it was. But I tell my clients it's really important to get something in writing. Keep records, keep receipts, get what do you call it? Notarized letters from the parents stating that this child is going to be in your household for this period of time. Put your name on something, put their name on something so you have some avenue for tracking, because I've seen too many bad situations to come out of it. I'll never forget there's one situation that I learned about and it was really heartbreaking because there was a stepfather who had taken care of some children for a number of years. And what happened was he had claimed the children on his tax return for a number of years. He had taken care of the kids and so forth, and he and the spouse weren't together, but he had taken care of the kids for all those years. And then what happened? They finally broke up. Eventually, the kids went back to their mom and so forth. And do you know that he had to pay back the money that he had claimed that he had for claiming him on his tax return? Now, he did the right thing, but the problem was he had nothing to document it. So if you're going to be out there claiming other people's children for one reason or another, please have something to document. Maybe because I believe there's a lot of legitimate people out there who are taking care of other people's kids, and I think that's a great thing. But understand they have to be in your household at least 7 months in order for you to claim them on your tax return. Okay, so that means the majority of the year they have to have lived with you. Okay, so I think I think that'll help you guys a little bit, help you guys out a little bit on the dependent section. So let's move on to the income section. Now, I have to tell you, I looked at the show last week and I said, you know what, Kim, you had too much on your mind. You must have been tired. I don't know what was going on. But I gave you guys some information about some minimum filing requirements. And I want to correct that because I didn't give you the entire amount of information. And there's so much that goes along with that. Um, First of all, when you file your tax return, you have to claim income from all sources, you guys. The only thing that you don't have to claim is child support. But you do have to claim your income from all other sources. So that means, let me give you some examples. For instance, that one, you want to claim all of your wages, your salaries, and tips. People forget about tips, but the IRS will get you when they know you've been working at the Cheesecake Factory for the last 5 years and you're not documenting your tips. They know that you're getting tips. You don't even have to tell them. They know it already. So if you're not claiming your tips on your tax return, regardless of whether or not your employer puts it on your W-2 at the end of the year, you will get in trouble for that. That'll be an issue that you'll have to face the IRS on. So if you're getting tips, you definitely want to make sure that you include that income. Also, for those of you who are getting alimony, you've got to include that as part of income. The IRS, they something else. They don't care who the money coming from. They said as long as you're getting the income, they want a part of it. So you got to make sure that your income from all sources you have included on your tax return. Okay. And let me just talk about a little bit. Let's talk about who must file a tax return. You have to file a tax return if you're self employed and you've made at least $400 in income. Okay. And that's really in your favor because I have seen business owners who said, well, even though I'm in the business of doing this or that, I really didn't make much money. And because I didn't make much money, I don't want to file a tax return. Well, you know what? Let me tell you something. The IRS also knows that you were in business. They don't know how much money you made, okay? And they assume that if you were in business, you made money. So what'll happen is, again, 2 years later, they start to figure things out. They'll say this person had a business, but they didn't file a tax return. What happens is, and especially here in the good old state of California, California will go back and bill you. They'll file a tax return on your behalf, okay, to estimate how much money they believe you owe them based on the business tax return you never filed. So you definitely want to make sure that if you are self-employed and you made at least $400, go ahead and file that tax return. You might not get nothing back and you might not owe anything, thank God, but at least you have done your due diligence in filing your tax return as you're supposed to. Also, if you have kids, and this is something I used to do when I first started out, I used to work with college students a lot because a lot of times college students they get these jobs or they get a good internship that'll last throughout the year and they'll make a pretty decent amount of money, but they won't file a tax return because they automatically assume because they're a student they're exempt. That is not true. If your child or teen dependent makes at least $5,700, then they've got to uh, file a tax return, or they may even, in some cases, um, be able to file a tax return with you. But if they have at least $5,700, they have to file a tax return. Also, if you are single and under age 65, you've made at least $9,750, you too should be um, you too are required to file a tax return. But if you're over 65, you make at least 11,200, you should be filing a tax return. Now I'm going through these because I know our shows are archived and you guys will have an opportunity to go back and listen if you miss anything. And I want you to get this information. You can also pull it up on the internet. If you're not sure whether or not you need to file a tax return, go ahead and pull this information up on the internet. All it is it's just filing requirements based on income. Okay. If you are head of household and you made 12,500, see, I already know them head of household folks. If you made 12,500, you're gonna file you're gonna file a tax return because you're trying to get some money back. So, and then if you're over age 65 and you made $13,950, then you're required to file a tax return. Now, if you notice, there's a bit of a jump whether or not you're below or above age 65. That's because government basically gives old folks a credit, old a credit. I'm sorry, y'all. I didn't mean to say it like that, but they give folks who are over the age of 65 a credit. So no disrespect to grandmas and papas and nanas and stuff out there, but they give the older folks a credit. Okay. And then if you're married filing jointly and you have at least $19,500, you have to file a tax return. And if you're over 65 and you have at least $20,650, you have to file a tax return. And And that's for one. If it's only one person is over 65, but if they're both persons over 65, your income has to be at least 21,800. And then for married filing separately, at any age you file and you made at least $3,800, which is the amount that's equal to a standard deduction, you got to go ahead and file a tax return as well. And then the other thing is, this is something you probably want to think about. Um, if regardless of whether or not you're required to file a tax return, if you've hit these minimums, you might want to file a tax return anyway. And the reason you may want to file a tax return anyway is because you might qualify for some of the credits. Like for instance, you might qualify for earned income tax credit, or um, you may um, qualify for a first-time home buyer credit. And these credits, some of these credits will actually allow you to get money back, regardless of whether or not you paid money into the system. So there's educational credits out there that you can get as well. So I just encourage people, regardless of what amount of money you made, and if there's a potential you're going to get, some kind of money back, I encourage you to go out there and file a tax return anyway. I'm gonna tell you, as a student, I started filing tax returns my own tax return very early, because I wanted to see. I couldn't take no chance on leaving any money on the table, so I went ahead and filed my tax return anyway, and I have to tell you, it blessed me well. So it was definitely in my best interest to do that. So I encourage you to file a tax return anyway. But again, if you're self-employed and you made at least $400, you are required to file a tax return. And then there's another situation. If you earn $108 or more from a tax exempt church or a church controlled organization, then you also are required to file a tax return. And I know you're thinking like $108. Come on, IRS. I mean, what y'all gonna do with $108? I don't know, but that's the stipulation that's the requirement that they have. So just know that if you received at least $108 as income from a church or a tax exempt church or organization controlled by the church, you have got to file a tax return. I know it sounds funny, but yeah, go ahead and do it. Just do what they tell you to do, because if you do what they tell you to do, you don't have problems later. And again, filing the tax return, even if it is only $108, at least that proves all I made this year as a church employee was $108. So that's all I have to report. Okay. So definitely want to go ahead and file that return based on those incomes. Okay. Oh, there's some other incomes that I really want you guys to think about as well. Sometimes you get interest back from maybe some investments or a bank statement, because maybe some of y'all, got some serious money in the bank. And at those times, you want to make sure that you claim that income as well. Yes, the little statement that you get at the end of the year from your bank saying that you have X amount of dollars in interest, you have to claim that on your tax return as well. So don't throw that paper away, y'all. um, and then if you have things like business income, of course, and then if you have capital gains from your investments. And I don't know that I want to go into capital gains just now on this show, but just know that your capital gains comes from your long-term investments. And if you have, if you're out there investing in the stock market, or you're investing in, any type of vehicle that's paying you interest, you want to make sure that you report that income, and because you do have to pay the taxes on that interest. So definitely keep that in mind. And then for those of you out there who are receiving Social Security, because I get this question all the time, people want to know, all I made was Social Security. Do I really need to file a tax return? Well, if Social Security is your only source of income, typically you don't need to file a tax return. But if you're getting Social Security, plus you're getting pension, plus you're getting retirement from this company, or 401k, or IRA from income from all of those sources, you got to file a tax return. You have to file a tax return at that point. And there are some limits, but I don't really want to share those with you guys at this time, because I think it's just going to confuse the heck out of you. So just know that if you are getting only Social Security, you don't have to file a tax return. But if you are getting Social Security along with other sources of income, you do need to file a tax return. So I think if you just stick with that rule, you'll be just fine. And in many cases, I think the rule is if your gross income is more than 25,000, then you do have to file a tax return for even if you're getting Social Security. So basically, I don't want you to get confused. Just know that if you are uh, receiving Social Security plus you're getting income from another source, you should go ahead and file a tax return. Even if you find out after filing the tax return that you don't owe anything to them, they don't owe anything to you, at least it's done. You've taken care of your responsibilities. Okay. Let's see. What's the next section here? Let's see. We're still in the income section. For those of you who are out there with rental incomes and properties, there's just no getting around it. You've got to file a tax return. So I don't even want to go into that. Just know, you got properties, you've got you're receiving royalties. Maybe you were an entertainer and you're receiving royalty out of what do you call it? Movie sales, whatever it is, what from the work that you did, you've got to file a tax return. Maybe you're part of a partnership, S corporation, trust, what have you. All of those things require you to file a tax return. And then I want to touch for a minute. I know I'm jumping around just a little bit, but no, I'm still in that income section. Gosh, y'all, that time is going by so fast. Um, but let me just go back to the IRA distributions for just a minute, because this is another section that y'all, at tax time, y'all, some folk be working my nerves coming in, talking about, well, I really didn't make any money, but I did take $20,000 out of my IRA, and I know I'm only 38, but do I still need to file a tax return? Yes, you do. Yes, you do need to file a tax return because the IRS want to see you because they're going to what you got to understand is a couple things are going to happen when you start pulling money out of your retirement fund, whether it's an IRA, it's a 401k, pension, whatever it is, when you start pulling money out of those accounts, the IRS, you get their attention, because what happens is they want to know, are you eligible to pull money from those accounts? And what happens? What does that mean? That means that you are at least 59 and a half. Let me say it again. 59 and a half. That means that before the age of 59 and a half, you should not be taking distributions from your IRAs, your 401ks, or what have you. Now, there are special circumstances. There are hardships that you can file. There are exceptions to that rule. But in most cases, if you pull the money out before you're 59 and a half, let me tell you what's going to happen. That money gets added to your current income. So let's just say you had a really hard year and you said, you know what, well, I wasn't really making any money on my job. I didn't work the full year. I made about $30,000 in income and I'm used to making 50,000 and that wasn't going to work for me. So I pulled an extra $20,000 out of my retirement account. Oh my goodness. Well, you just made $50,000 for the year. And so the IRS is going to tax you as though you made $50,000 for the year. And not only are they going to tax you, but they're going to give you a 10% penalty for pulling out that money out of that retirement account. So you really, really want to think long and hard before you pull money out of the retirement account, because I've had so many people who are come to me and say at the end of the year, one or two things. They thought they were getting money back, but they're not getting money back because of that penalty ate up whatever potential refund that they had coming back, or they owe money at the end of the year because they took all that money out of the retirement account. And I'm going to tell you something. If you're already having a hardship, I mean, again, there are special circumstances when you have a hardship. You're going to have to basically show that you were oh goodness, what's that word when basically you had more bills than you had income. I can't remember right now, y'all. Every now and then my brain does freeze up. I think sometimes I just put it on overload trying to know all this stuff. um, but there are special circumstances where you can file for hardship. But I'm going to tell you, you really got to cross all your T's and dot all your I's, because they are very particular about what things you can actually spend that money on, even when you take a hardship. So just know that, before you pull money out of your retirement account, you really should talk to your tax advisor, or at least give them a call while you're on the phone with the people trying to pull the money out, so that they can give you some advice and so you know what to expect. And I would encourage you to to actually have that money pulled out. And I'm going to tell you, in many cases, they may pull out the federal money in advance, the federal taxes that you owe, but they won't pull out the state. And y'all know, state of California come after you like a vengeance. So, and they broke too. So, so you better figure out how to take a portion of that money and put it aside for the state, or tell it, just send the state a letter in the mail saying, I know I'm going to owe you, so here's your money. No, I'm kidding. Don't do that. But you definitely want to figure out how to get their money to them. Okay, so let's just move on. Let's go ahead and move on because I think I've covered all the key areas. Oh, for those of you who might have been on unemployment, don't think that you're just exempt. Because it really depends on how much money you made in unemployment. So even if you just received unemployment for the entire year, you want to go ahead and file a tax return as well. Let's see. I'm going to go ahead and take just a little bit of a break because I think my voice is getting a little parched, and we want to give our sponsors a moment to, you know, basically, say what they do. So let me go ahead and take a few minutes break, and we will be back in a moment. I'm your host, Kimberly Kelly-Rolfe, on Kick Your Assets into Shape on LA Talk Live. I'll be back with you in a moment. Make your check come at the neck. Disrespect us, no they won't. Boy, don't even try to touch it. Boy, this beat is crazy. This is how they make me. Houston, Texas, baby. This goes out to all my girls up in the club, rocking the ladies. Who will buy it for themselves and get more money later? I think I need a barber.
Hi, this is Dawn Christie inviting you to join me every Friday, 1 p.m. Pacific, for my all-new show, The Dawn Christie Show. Join me as I discuss love, spiritual readings, your purpose, why am I born, what am I here to do. So don't forget to tune in The Dawn Christie Show at 1 p.m. Pacific, exclusively on LA Talk Live. You can also catch us on iTunes Radio R&B or watch us on Ustream TV, reality radio, handcrafted for your listening pleasure. This is LA Talk Live, and we are more than just talk.
Hi, this is Julie Orlov inviting you to join us every Friday at 2:30 p.m. Pacific Standard Time for our all-new show, Pathways to Love. Join us as we talk about love and relationships and how you can create the relationships you desire. So don't forget to tune in to Pathways to Love every Friday at 2:30 p.m. Pacific Standard Time, exclusively on latalklive.com. You can also catch us on iTunes Radio R&B, Live 365, Radio Flag, and now Stitcher Radio, or watch and listen directly at latalklive.com. Reality radio handcrafted for your listening pleasure. This is LA Talk Live, and we are more than just talk.
Hi, this is Romy Klinger.
This is Rose Garcia.
And we are inviting you to join us for the Romy and Rose Show every Friday at 4 p.m. Tune in for the Romy and Rose Show. We're going to be talking about pop culture, dating, business 101, what's ratchet, what's not ratchet, and music and so much more. So don't forget, tune in to the Romy and Rose Show. About to get real.
Exclusively on latalklive.com. You can also catch us on iTunes Radio R&B or watch us on Ustream.tv. Reality show handcrafted for your listening pleasure. This is LA Talk Live, and we are more than just talk.
We're real talk.
And we are back to Kick Your Assets on Into Shape. Kick Your Assets Into Shape on LA Talk Live. I'm your host, Kimberly Kelly-Rolfe, and we are talking about taxes. I hope I'm not wearing you guys out, but I really, really, really want to make sure that you get some good information here today on taxes. Just in case I didn't express it enough in the last segment, I want you small business owners to make sure that you too are definitely responsible for filing a tax return. So if you made at least $400, small business owners, you've got to file a tax return. we are actually at the top of our hour and we only have a few minutes left, but there are a couple of topics that I really, really, really wanted to make sure that we covered. And there's a couple of questions I get asked all the time, and let me go ahead and just address those while we got a little bit of time left. One of them is people always ask about tax brackets. What are the tax brackets? Well, the lowest one right now is 10%, and the highest one is 35%. So just know that typically you'll get taxed anywhere between 10% and 35%. Let me give you just a little bit of breakdown. If you are single and no, let me change how I say that. You're in the 10% tax bracket if you're single and you earn up to $8,700, or you're married and you earn up to $17,400. You're in the 15% tax bracket if you're single and earn between 8,700 and 35,350 dollars. That's if you're single. And if you're married, you're in the 15% tax bracket if you earn between $17,400 and $70,700. Okay. Now, for the 25% tax bracket, if you're single and you earn $35,350 to $85,650, or if you're married and you earn between $70,700 up to $142,700, you're in that 25% tax bracket. The next bracket is the 28% tax bracket. If you are single and you earn between $85,650 and $178,650 if you're single, and if you're married and you earn between $142,700 and $217,450, you're in that 28%. You hit the 33% tax bracket if you are single and you earn between $178,650 up to $388,350. And then if you're married and you earn $217,450 and $388,350, now you're in the 33% tax bracket. And then finally, you're in the 35% tax bracket if you are single and you earn $388,350 or more, and if you are married and you earn $388,350 or more. So just know, for those of you who earn $388,350, whether single or married, you will be in the highest tax bracket, which is the 35%. I wanted to share that because that's a question I get asked all the time. Everybody wants to know, what income tax bracket am I in? So if you didn't get all of that, or you couldn't write it down, just run back, listen to the show again, back it up, and you ought to be able to get those specific numbers. You can also look it up on the internet. They'll give you that information as well. Another thing that I really want to touch, gosh, we're running out of time quickly, you guys. I'll try and save some of this information and hopefully give you just a few more tips as we go along through tax season. So maybe I can just add in a little segment, what's called the tax tip of the day or something like that, just so that I can give you guys some important tips along the way. But there's another credit that people are always talking about, and that's the earned income tax credit. What the earned income tax credit, it's a pretty popular credit because it's a refundable credit, which means that, like other tax credits may reduce the amount of taxable income that you have, this tax credit actually allows you to get a certain amount back. Okay, so with the earned income tax credit, the way it works is you get this credit based on how many qualified children you have, and also based on the income that you have. So for 2012, the maximum amount of earned income credit that you can actually receive is $5,891, and that means that you have 3 or more qualifying children. Okay? Now, if you have 2 qualifying children, the maximum amount that you can receive is $5,236. With 1 qualifying child, you receive $3,169. And then with no qualifying children, which means that you have very low income, you can receive a maximum of $475 in this refundable credit. Now, I'm going to tell you guys something right now. Don't run out to your tax preparer when they file your tax return and you don't get a refund back of the maximum earned income tax credit. That is not the way that credit works, okay? It's not the way it works. This is the maximum amount that you have the potential to earn from this credit. Now, when you take your income into factor, that can reduce the amount of earned income tax credit that you have. Now, for 2012, if you earn $45,060 and you were single, or $50,270,000 with three or more qualifying children, then you could qualify for earned income credit. Actually, that's the maximum amount. So, which means this. If this is the maximum amount, once you hit this amount and more, you no longer are within the range to qualify. Now, I'm going to tell you, the higher your income is with the least amount of children, the less you're going to qualify for this credit. So let me just go down really quickly and tell you, if you have two or more qualifying children, the maximum your income can be is $41,952,000 if you're single, and $47,162,000 if you're married. For one or more qualifying child, the maximum income is $36,920 if you're single, or $42,130,000 if you're married. And then with no qualifying children, if you're single, the maximum income that you can have for this credit is $13,980, and if you're married, it's $19,190. So just understand that the higher your income is, the less amount of money of this credit you'll actually be able to receive. So if your income is already at the top, understand you will not get the maximum amount. You will probably get the least amount, okay? So I want you to understand that clearly so that you're not running back to your return, tax preparers and asking them where's the rest of your money, because or this is the one that really kills me, is when you guys come to me and you say, well, my friend's tax preparer got her back this amount. Baby, everybody's tax situation is different. Unless you and your friend have the identical situation, which means that you made exactly the same amount of money, you have the same filing status, you have the same number of exemptions, which means that you have the same number of dependents in your household. Your dependents are right about the same age. You made the same amount of income. You had the same things such as your contributions to your 401k. You had the exact same amount for educational credits. Unless your situations line up to a T, I don't care if you're twins, you work with the same job, you have the same amount of kids. It's no guarantee that you're going to get back the same amount that somebody else does. In many cases, you will not. So don't go to your tax preparer saying, my friend preparer got them this amount. That is irrelevant. Everybody's tax situation is unique. You're going to get back or have to pay what's unique to your situation. So just understand that. And don't flock to tax preparers thinking they're going to do this for me or they're going to do that for me. What you want to do is you want to find a tax preparer who ultimately understands the tax law and who can help apply the most, all the credits that you have coming your way. And then you also want a tax preparer that can help you to employ some strategies to position yourself to be in a better position. So maybe if you owe this year, I'm going to tell you, I tell my clients all the time, if there's a new client who comes to me and you owe this year, we're going to work out a strategy so that next year you don't have to owe. Okay. And I feel like as a tax preparer, that's the minimum amount that I can do. There's also, certain things that you can do to position yourself better. Understand your goal as a tax filer, it's not for you to get money back. You want to break even. You don't want to owe them and you don't want them to owe you. Why? Because when they owe you, that's like giving the IRS a tax-free loan. And that's not what we're trying to do. We need all the money that we can get in this economy. We need to try and keep as much money as we can in our pockets. So you sit down with your tax preparer. You go into a tax planning session. As I stressed in the last show we did last week, it's so important that you don't just wait until the end of the year to see, or the beginning of the year to see your tax preparer. When you have taxable events that change. Maybe you got a promotion at work. Maybe you had another child. Maybe you started investing. Maybe you purchased a home. Those are all the times actually leading up to those events that you want to talk to your tax preparer, because you want to let them know. You want them to let you know how these situations are going to affect your taxes. Maybe you started in a new business. Whatever. These are the things you need to begin to talk to your tax preparer about so that you can be prepared for your tax liability. I want to thank everyone for tuning in today. I hope you have a wonderful weekend. I've certainly enjoyed this time. I'm going to try and come back and give you a little bit more information each week as long as tax season is in, so that you can have a few tips to making your tax life a little bit better. Thank you for tuning in to Kick Your Assets into Shape on LA Talk Live. I'm your host, Kimberly Kelly-Rolfe. I will see you next week, Friday.
Try.